What I'm going to do here is actually slightly different. And it also comes with managing your clients, because they're going to come and ask you questions. We're in a situation right now where the market outlook, what's going on in terms of the global economy and financial markets in particular, is a little bit uncertain. So I'm going to come here and January is always a good time to give an outlook of where we've been and what we expect to happen over the next, let's say, 6 to 12 months. So that's what I'm here to do. Now, at Guardian Capital, I have a dual role. I run sort of our multi-asset strategies, which are tactical balance funds basically, but the other thing, which I view one of my important things, and this is what I've done pretty much my entire career, is I'm an economist. And I think the most important thing that an economist can do, can bring to people like you who run your businesses, is this idea of context. Because there's a lot of information out there. There's a lot of news in the marketplace. Financial market pundits, business TV will have tons of headlines. But what does it actually mean? What are the actual implications? So my job today, what I'm going to try and do, is provide some context on what you're actually seeing in the press, seeing what's going on, so you can actually relay this to your clients. And sort of, it's like an educational viewpoint. In my presentation this morning, I move around a lot. I apologize. I like to walk. I like to use my hands. So I hope that's not too distracting. But presentation this morning is, the reports of my death are greatly exaggerated. That's a quote that's been attributed to Mark Twain when he read an obituary about himself in a newspaper. And as you'll see, this relates to our current macro backdrop, our current outlook in terms of how the situation is. So, starting. Last year was a rough year for financial markets. So this chart looks at the overall return of the MSCI World Index. So global stock markets fell 10% last year. And that is very significant because that is, outside of a recession, one of the largest declines over the last 40 years. All right, this is looking at data since 1970. The only periods where we had bigger fall-offs outside of recessions were the 2 years on either side of the correction, or the recession around the tech boom and tech bubble bursting. All right? So this is a very abnormal result for a year, especially when, for all intents and purposes, growth was actually pretty good. So the question is the financial markets, our stock equity markets, telling us something about this expansion? Is it running out of steam? We are, after all, in the 10th year of this bull market, 10th year of this economic expansion. Well, you need to have some context. So we had a lot of volatility. This is looking at the VIX, so it's a measure of equity market volatility. Chart on the left is a relatively short time horizon. And after being extremely historically subdued in 2017, where there were no equity market corrections, the S&P 500 actually increased every single month of the year, which is the first time that has happened on record. We have a little bit of volatility, these big spikes. And looking in this context, it looks fairly scary. These are big jumps. These are equity markets moving fairly sharply. But if you take a step back, given more history, look at other periods of time, actually not that abnormal. All told, the volatility we saw, these movements in the market, were pretty much in line with normal. And there were nowhere close to more scary situations like the financial crisis in 2008-2009, which is the Lehman Brothers bankruptcy that got highlighted there. Or even looking at Black Monday when markets crashed in 1987, massive spikes. And actually, these are sort of basically blips. Now, corrections in equity market volatility is not exactly the most enjoyable thing when you're involved in it. But the concern is when you have abnormal amounts of it, because then that's really scary. That's the time to abandon ship. But again, talking about the movements in the market, so this looks at the number of days where you have fairly extreme changes in the market, so either up or down by 1%. Now, 2018 seemed fairly bad. However, you put it in a long-term context, it actually wasn't. It was in line with normal. What was abnormal is what we went through in 2017. We only had 3 days where global equity markets went up or down by 1%. Okay, emphasize, that is extremely abnormal. Because looking at this line, it is the average over the last, from 72 to 2016, so basically 4.5 decades. We're pretty much bang on in line with that. So this recency bias, what happened in 2017 is fresh in our minds, and it makes everything seem very scary. But again, volatility. Now the question is this volatility, is this pickup relative to the year before telling us something about the expansion? And to what I say with that is, a Nobel-winning economist by the name of Paul Samuelson said in the 1960s, when asked about what the stock market's doing in terms of prediction of the economic outlook. And he said, equity market has a very good track record. It has predicted 9 of the last 5 recessions. And reality is, despite how volatile everything seems, despite what the news headlines are saying, the actual economic macro backdrop is okay. It's not amazing. We're not going to see returns to the mid-90s growth where you're seeing real GDP expanding at 5% rates, but we're not seeing it roll over. We're sort of in that in-between phase where growth is going to continue. It isn't going to be the most stunning thing we've ever seen, but it's not rolling over, and that's what matters. So looking at this, I look at the GDP growth for the G7 economies, looking at pretty much the beginning of this cycle, the first, let's say, 8 years of it, and looking at where we were in 2018 and where we are expected to be in 2019. And yes, there's some moderation expected from what we saw last year, but we're still going to be relatively in line, if not a little bit better, than what we've seen over the previous 8 years. And from a market standpoint, the last 8 years have been pretty good. And now these are just looking at forecasts. If we look at the actual data, this is the Purchasing Managers Index. So you have some groups that go out and they collect information. They do run surveys of businesses and saying, what are you seeing? Where are you seeing in terms of new orders? Where are you seeing in terms of activity, business investment, and hiring? And it's a really good historical gauge of economic momentum. It's a leading indicator. And what we're seeing is absolutely we saw a pickup in 2017 and in the first half of 2018. The expectations were there. And things have moderated. There's no denying that. But what really matters, and this is where context is important, this moderation is coming from very high levels. And what we're still seeing is it's still growth. And it's not just growth in the US. It's not a situation where you have the haves and have-nots, one area leading and everybody else sort of bringing up the rear. It's broad-based. You've got the emerging markets. You've got even the UK, despite what's happening, they're still projecting growth. And this matters because when you're talking about the sustainability of an economic expansion, the sustainability of a bull market, that broader that base, the harder it is to knock off. So the reality is, we are seeing momentum slow, but it is still growth momentum. And I think one of the best gauges, because you can look at sentiment indicators, which is considered soft data because it's not actual there. It's not actually sort of what's happening, it's what people view as happening. You can look at the GDP data, which a lot of it is estimates from really smart people, but still estimates nonetheless. Other way of looking at it is, how strong is the economy? Are businesses hiring people? You look at the unemployment rates. And what we've seen is there is a massive, strong demand for labor across the globe. Again, this isn't just a US-only story. This isn't Canada or Europe. It is everywhere, despite the volatility, despite the negative headlines. So this chart's looking at unemployment rates, and it's overlaying where they've been from the cyclical peak in the aftermath of the recession to 5 years ago, 1 year ago, and where we currently are. And they have been steadily declining. To the fact where in places like Canada and Germany, in particular, we are at record low levels of unemployment. When there is ample demand for labor, when people are hiring, you kind of have to argue that business conditions can't be that bad. Because if you're adding headcount, there's demand for your goods. Now, again, we are in the 10th year of this economic expansion. And in the aftermath of the great financial crisis, there was a huge amount of people who were laid off from their jobs. There was a massive dislocations that created ample slack in the labor market. But after 10 years of steady, continuous, persistent job growth, we're seeing, again, the slack in the labor market disappear. And when you see slack vanish, so the supply of inputs to demand or to production diminishing, and the growth of demand still remaining sort of fairly strong, you see prices start to adjust. And this is what we're seeing is inflation rates are moving higher in developed markets economies in particular, where they're more mature, in more mature stages of their cycle. Now, this has implications from a policy standpoint, but the important thing I want to highlight too here is we're seeing inflation pick up, but not aggressively so. So if you look at the developed markets, so looking at Eurozone, US, UK even, and Canada, we're still seeing inflation hold around that 2%. So it's rising, but it's benign. That means you're not going to see any sort of knee-jerk reaction. There's no reason to have a knee-jerk reaction from central bank policymakers in terms of interest rates, which is one of the reasons why the party can continue to roll on. You're not going to have credit choked off. But one of the reasons why I'm highlighting inflation and price growth there is when we're talking about financial markets and we're trying to get an idea of whether or not we're seeing a recession on the go. Like, so the equity markets are telling us that things are going to get worse. You have to take a step back and just saying, all right, so overall demand is growing. So the number of units that businesses are selling is growing. And the prices with which they can sell those units is rising. Those ultimately mean revenues are increasing. And revenues ultimately go down to earnings increasing. So when you're buying a stock in a company, you are buying a right to have access to those cash flows from earnings, right? So what we're seeing, and this is something that really I think is heartening, is the light line or the gold line there is the equity prices. The darker line is the earnings. So we had a huge dislocation in the early 2018 where prices went way beyond where earnings were suggesting, looking at the valuations there. But now we've swung in the absolute opposite direction where earnings and the fundamentals have been okay. They're continuing to grow. We're seeing that upward direction, but it's prices that have fallen off. So inherently, when we're looking at from a macro standpoint, we're trying to step back and see, is this a situation where we should start being more defensive, being concerned about the outlook? Or is this something that's presenting opportunities? If it's sentiment that's driving the equity market behavior, it creates opportunities. And talking about sentiment, this is a chart that looks at investment advisors, people involved in financial markets. They do a survey and they ask them, are you bullish on the outlook? Do you think stocks are going to go up? Or do you think they're going to go down? And do you think they're going to go down far? And looking at this historically, if we look in 2018 at the beginning of the year, we had this excessive degree of optimism. So basically it was a 5-to-1 ratio of people saying, yeah, things are going to go really, really good. Now the problem with that is when you have everybody expecting the absolute best, it sets that bar for things to get better really high, right? You get in a situation where getting good results, getting good data isn't necessarily good enough. And that's the kind of thing that can spur on a correction, which we saw in early 2017 or 2018. But what's happened throughout the year, and especially in the last 3 months of 2018, is sentiment swung massively in the opposite direction. Where now the bar is set really low, because the last time we had this degree of pessimism was in February 2016. And after that, markets actually performed really well. And if you go back further, we've got 2017, or around 2011, 2012, which is around the European sovereign debt crisis, and none of these actually derailed anything. It was a sentiment swing. The fundamentals of the outlook were actually in good shape. But the important thing here too is when you have the bar set really, really low, even when you have some sort of bad result, it's not as bad as people were fearing. And it's interesting to watch financial markets right now because it's earnings season for equities. And you have a lot of companies that are coming out and they're reporting lower earnings than expected. And they're bringing their guidance for forward expectations lower. They're still expecting growth, it's just lower than anticipated. And what's happening to these stocks? They're actually rallying because people are expecting the worst case scenario. Sentiment is really low. So when you set that bar, the balance of risk is suddenly to the upside, whereas last year at this point, it was skewed in the opposite direction. Now, what has been skewing sentiment? Without a doubt, the one thing that financial markets hate more than anything, the one thing investors hate more than anything, is uncertainty. You want to know where your company that you've invested in is going to continue to make money. You want to know for certain that there's going to see a degree of growth. So you can just sort of take that to the bank and sit and wait. But what we've seen is a massive spike in uncertainty. So this chart is called the Global Policy Uncertainty Index. A bunch of academics from Europe and in the US have come together and trying to quantify this intangible idea of uncertainty. And they've got this index. So they look at newspapers, they look at, they do sentiment surveys, they do look at economic data, financial markets, a lot of stuff in there. And we're seeing this sharp uptick, this sharp spike, and actually the updated version of this data, which came out a couple days ago, shows that we're even exceeding that 2016 election peak there. So, given that the macro outlook's generally okay, why are we seeing this degree of uncertainty? Well, more often than not, uncertainty like this, it's driven by politics. A lot of these are political events. Now, does anybody have an idea where the biggest source of that uncertainty may be? So I'm not going to dive too much into his specific politics because that's not what I'm here for. But emphasizing the fact that markets hate uncertainty, if you have someone who on a day-to-day basis, based on what he feels, will change his viewpoint on something, he will create uncertainty. He will take to Twitter, he will make a comment that isn't necessarily warranted and can blindside people. It creates uncertainty. Uncertainty creates volatility, uncertainness, right? But, so that is one area. And now talking about context, I'm going to just sort of drift into the biggest area that he's sort of that the US administration is impacting the outlook and impacting growth and financial markets. So despite what some people may think, international trade is not a zero-sum game. There are no winners and losers from trade agreements. It is actually mutually beneficial to everybody involved. It lowers prices, it creates bigger markets for businesses to have access to, bigger client bases, and it is not a coincidence that especially over the last, 20 years, as we've seen these developments of globalization, we've seen barriers to trade go down, that we've seen this tight correlation between trade volume growth, so the amount of goods being exported and imported across all borders globally, and global growth. They kind of go hand in hand. And trade is one way that you can see it creates a virtuous cycle of growth. It is the way where rich countries, where they have growing demand, see that suddenly they're importing goods from abroad, which can then spill over. That's the way wealth is shared. All right? It can pull things along. It is a positive. So putting up any sort of barriers to trade is actually a negative for trade growth, which ultimately is negative for economic growth. And this is something that's concerning because you have these threats of trade barriers going up. And in particular, the biggest focus of the US administration is China. Because China exported, and this is now looking at 2017 data because it's the viewpoint to sort of set the basis for these disagreements they had. China exported about $500 billion worth of goods to the US. All right, that's this big black line here. And if you look at the other countries, it's head and shoulders, even in terms of Mexico and Canada, which are geographically adjacent to the US. China shipped more goods to the US, right? And apparently that's viewed as a bad thing because it's dollars going outside of the US borders. But it's not as if the money is just being shipped for no reason. Like the US consumers, US businesses are getting goods that they can either not get domestically or they can get it at a cheaper price. It's beneficial. But the thing is, by focusing on these exports and by doing so and trying to assert dominance over the Chinese economy, you need to put it in scale. $500 billion is a big number. But in the context of the size of the Chinese economy, it's actually fairly small. It's less than 5%. So this is looking at exports as a share of GDP. And, big number in terms of absolute dollars, but relative impact, fairly small. So if you're trying to really impact and crimp the Chinese economy, this is not the best way of doing it. However, by putting up these barriers to trade, you're having a bigger impact on a lot of smaller emerging market economies and other nations like Canada and Mexico. Luckily, Canada and Mexico are sort of a momentary reprieve with the agreement of NAFTA 2.0, but when you have some uncertainty about who's going to be the next domino to fall, who's going to get the next focus, you create this uncertainty surrounding these economies in particular in terms of the economic outlook, and that can weigh on their growth outlook in terms of businesses investing there, consumer spending, and that creates a negative cycle. Now, the thing I want to highlight, emphasize in the context, one of the reasons that this trade war was even begun was the argument that you need to level the playing field between China and the rest of the world, in particular China and the US. And you look at it, China does have tariffs. But that's not the only barrier to trade that exists. And actually, if you were to go and compile other things, so looking at quotas, licensing agreements, things in terms of labeling and regulation, sort of health regulations, it actually is the fact that, do I have the laser? The US is more closed off than China, right? So the basis for this argument that first off, money is leaving the US, which is not exactly accurate. It's not that the US is losing money as a result. And the fact that the emphasis that the playing field isn't level, also not quite accurate. The US is actually closer to sort of emerging market economies in terms of its openness to trade than it is other developed world economies. This is something that needs to be thought about, right? In terms of, is this the correct direction to go? The other thing to emphasize is nothing in the world exists in a vacuum. The US goes and they put up tariffs on goods that are made, that are being shipped from China to the US. Is the expectation that there's going to be no retaliation? Or that there's no negative implications, no negative indirect flows of trade as a result of this? Actually, no, nothing exists in a vacuum. So what we're seeing is one of the big negatives of this trade war, and instigating a trade war, is it has negative domestic implications on the US. Because number one, tariffs. Despite the fact what some policymakers may think, it is not China paying the tariffs. It is American consumers and American businesses. And what we've seen, this chart looks at the US government's tariff customs duties revenues. And they have actually doubled from a year ago, right? So right now it's around $7 billion a month worth of tariffs that the US is actually making. This actually flows to the bottom line of American businesses. They are suddenly having to pay higher costs for goods that they are buying from abroad. And some of them, inputs to production, that's kind of a big deal. Other thing is, because of China, like the globalization that we're currently seeing, so the freedom of flow of goods across borders, and China playing a significant role in terms of the global supply chain, everything that China exports isn't made strictly in China. In fact, only about slightly less than 2/3 of the goods that they export, the value of it originates from China. Now, what's interesting is, what's the number 2 source of goods, of value added to goods that are exported from China to the US? It's actually the US. So that means you have American firms making something, shipping it to the US, or shipping it to China, China doing some work on it, and shipping it back to the US. So by putting up tariffs, by putting up barriers to goods that are exported from China, you're actually impacting American firms, directly impacting there. And the second thing too is, China's putting up tariffs on goods that are being imported from the US. Now, despite what people may think, the US actually exports a lot of goods to China. They're the 4th largest exporter to China. So you throw up barriers to trade suddenly, and you're impacting everybody who's got client base in China. And in particular, the areas that they targeted, agricultural commodities in particular, seen massive fall off. So soybean farmers in the US, they spent about 15 years trying to gain access to the Chinese market to sell their goods. And what they've seen is that it was, I think, roughly 95% of soybeans produced in the US were shipped to China. The number of exports to China of soybeans went to 0. Okay, so the government had to step in and subsidize them. These are domestic impacts that are fairly significant that need to be taken into consideration. One of the reasons why ultimately you think this is not something that will persist. There are pressures that could cause, a positive solution to occur. And the expectation is you're going to see that sooner rather than later. Now, the other thing that gets a lot of attention now in financial market news is this idea of the yield curve. So the yield curve, which is this on the left, it's the difference between long-term and short-term interest rates. And why people like to focus on it is, if you look at this, when that gap gets really small between the two, and when they get to a point where the yield curve inverts, so short-term rates are higher than long-term rates, it is a good historical gauge of recessions. So typically when you get that yield curve inversion, within the next 12 to 24 months, there's a recession. Now, the practical reason is because financial institutions, lenders, they will borrow in the short term, lend for the long term. And that gap is the profit they make off loans. You reduce that gap, you make it shorter or make it disappear, there's no incentive for banks to loan, credit growth dries up, businesses can't expand, they can't hire, growth slows. But again, looking at where we are right now, this is one reason it's getting flagged, is the yield curve is getting very flat. The gap between those two is shrinking. And as a result, so using you can do a bunch of fun mathematical stuff. You can get a model of the probability of a recession over the next year by looking at strictly where the yield curve is. And right now, based strictly on the yield curve, there's the highest probability of a recession in the next year that there's been at any point this cycle. So this is the bond markets waving a red flag and saying, hey guys, we think that the conditions are getting worse. But there's two things I want to emphasize in terms of context here. One, we're not actually inverted yet. And it's when you get that inversion that historically leads to a recession over the next 12 to 24 months, which is a fairly large lag to begin with. The second thing, the flatness of the yield curve is kind of by design. Normally, when you're going through an economic cycle, so you have a recession, central banks will go and they will cut interest rates. And they can impact the short-term interest rates, like the very, very short term, so the front end of the yield curve. So what we're seeing is after the financial crisis, economic conditions have improved, and you're starting to see interest rates, policy rates start to go up. So that's the front end of the yield curve is starting to rise. But this last financial crisis, this last recession, was distinctly different than any one that we've had over basically since the Great Depression. And central bankers didn't just focus on and cut the short-term interest rates. They did a lot of stuff to try and cut long-term interest rates. In particular, they went into the market and actually bought bonds. So you had the European Central Bank, Bank of England, Bank of Japan, and the Federal Reserve buying roughly $12 trillion worth of bonds in the market. Now, that's equivalent to roughly these four central banks alone owning about just under a quarter of the global bond market. All right? That is significant manipulation in terms of where interest rates are, market interest rates are. Now, what that does is it puts longer term rates lower, it makes the yield curve flatter. But what's happening right now is this bond buying is actually, like those assets on the balance sheet are falling off. It is declining. The US has stopped buying bonds, and they've actually started allowing their balance sheet to shrink. In Europe, they stopped buying bonds in December. And even though the Bank of Japan is going to continue to add to the balance sheet and buy bonds, they're playing a fairly small role. So what that means is you get this anchor at the back end of the yield curve, it's suddenly loosening. So that flattening of the yield curve, it's entirely possible that we see it sort of stall out where it is. And if anything, maybe even drift a little bit higher. So that's one thing you need to think about in terms of recession. Like, historically, it's been a great gauge of recessions, but historically, we haven't had this degree of intervention by policymakers in the market. So it's not giving you a clear guide of what the market is actually thinking. And emphasizing this too, so we've seen a fall off in equity markets. We've seen a fall off or signals being in the government bond market. But there's, again, nothing exists in a vacuum. There's all these other things that are giving, taking. And the one thing that we like to focus on is credit spreads. So this is looking at corporate bond yields relative to government bond yields. And what we've seen is corporate bond yields have started to increase a little bit relative to government bond yields, but it's nothing close to previous recessionary levels. What this means is investors and people who are buying corporate bonds, so either high-grade investment grade bonds, so ones where there's no concern about credit quality, and even the lower tier high yield like junk bonds, there's not really that big a concern about people who own these bonds getting repaid. And in fact, because you have this positive macroeconomic environment, because you're seeing companies being able to generate profits, and considering the fact that with an equity, you're not guaranteed to get any sort of lump payment at any point in time. But in a corporate bond, or a bond in general, you're guaranteed, like you have a guarantee of a payment on a specific date. And if you're certain that you're going to get paid, there's no reason not to own those bonds, especially if they offer you a nice yield over anything else in the marketplace. And what we're seeing is default rates. So these are the junkiest of junk, high yield corporate lender or corporate bond issuers. They're seeing the default rates, so their ability to actually make their payments is improving. Like default rates are falling. And it's, again, not just a US story. It's not just a oil price or energy story. It is a global phenomenon. So when you have that valuation anchor of the specific payments, that's kind of a gauge. Is there an actual reason to be concerned about the macro outlook? And right now, the corporate bond market is saying, not really. We're okay. We're still confident that we're going to get paid. And again, you're talking about interest rates. Interest rates, especially on corporate debt, they've been increasing. Interest rates in general are expected to increase over the next year. But they're not at punitive levels. We're nowhere close to where we were around the financial crisis, nowhere close around the tech boom and tech bubble bursting, nowhere close to where we were even like the 1990s. And likelihood is we don't necessarily get to that level. We're not at interest rates that are too punitive for corporates, for businesses. That means there's still a capability, they're not going to be constrained. They can still generate profits. They can still invest. And there's all these positives. And this is something I like to highlight is even if interest rates continue to rise, that isn't inherently bad for financial markets. It's not bad for equities. Because you need to think about the context in which interest rates are rising. So this chart, going left to right, it's, I guess from the middle to the left, it's interest rates being cut. So change in interest rate over a 12-month time horizon, and interest rates going up at a 12-month time horizon. And what the history shows us is when interest rates are going up fairly gradually, so let's say 0 to 100 basis points, so 0 to 25 basis point hikes by a central bank in a given year, it's actually the best possible scenario for equity markets. And the reason is, if policymakers, if markets are thinking or are pushing interest rates higher, that means they're in a situation where they think the economy is actually doing okay. Inflationary pressures are going to rise. So interest rates are likely going to, it's a positive economic backdrop. So if you're getting this scenario, just because interest rates are rising, not actually negative for equities from a historical basis. There's a scope for things to continue to, like the bull market to continue. And again, it's emphasizing the fact that nothing exists in a vacuum. When you're looking at whether or not to own a stock versus whether or not to own a bond, and it was a situation where, especially at the beginning of last year, where equity markets were expensive relative to their history. But interest rates are still historically low. So on a relative basis, and you're looking at the relative yields offered by either stocks or bonds, equities are relatively cheap compared to bonds. And that's still the case right now, even though we've seen some increase in interest rates. And it's like a historical basis. So when you're trying to think, and again, one of the things I do is I manage our tactical managed funds. So it's like balanced accounts and trying to figure out how do we tilt our allocations. You want to buy what's cheap and sell what's expensive. So from our viewpoint, especially given a relatively positive economic outlook, there's still reason why we're tilting towards equity markets. And again, emphasizing last year at this point in time, equity market valuations were expensive. Equities were expensive relative to their history. So we were at the one standard deviation band versus on their 30-year history last year. But because we've had sentiment swing and prices fall at a time where earnings have actually continued to improve, we've seen this headwind, which we saw last year, actually turn into a tailwind. So even right now, if we don't see valuations increase, as long as earnings keep growing, you can see equity markets perform. But there's actually scope, even if we just return to sort of what's historically normal, for valuations to increase as well, sort of adding to potential returns. This is something that creates an attractive environment. We're not necessarily saying you're going to see like 30% gains in equity markets, but seeing the odds of seeing things decline over the next 12 months, not particularly high at the moment. And this is a situation, too, where it's not strictly the US. So the last chart was looking at the S&P 500 valuation. This is looking at global market, equity market valuations relative to their 10-year average. And globally, equity markets look cheap. Right? This is something to be considered. So it's not sort of one specific area. It is broadly based because it was pretty much indiscriminate selling because sentiment swung. It wasn't a specific catalyst for why markets did poorly over the last, let's say, specifically the last couple months. It was just sort of dumping the baby with the bathwater. There's a lot of good out there. And this is just something to keep in mind from a context standpoint. Now, because we're Canada, and just as, again, another macro thing that people like to focus on is trying to gauge in terms of the healthy economic outlook and has significant implications for Canadian economy as well, is this idea of oil prices. And generally, people will look at when oil prices fall, it is the market giving us a signal that they expect global demand to decline. Because if demand is declining, that means demand for inputs to production, so commodities, is declining. And in theory, when you have a fixed supply and demand falling, then you should have prices fall to adjust. And what we saw, especially in the last quarter of last year, is we had basically, after finally gaining some traction after the collapse in 2014 to 2016, oil prices started moving higher, only to sort of hit a peak and roll over aggressively. And this is around the time when people are starting to flag growth concerns. Now, context. This actually was not something that was driven on the demand side. So what happened in May of last year, and this is when we started seeing prices start to increase more aggressively, is the US pulled out of a nuclear agreement with Iran, along with other countries. And the idea was, as a result of pulling out of this agreement, they were going to issue sanctions on Iran and anybody who did business with Iran. They explicitly stated that their goal was to get Iranian oil exports down to zero. Now, Iran is not an insignificant player. They generate about 4 million barrels per day of oil production. So when this announcement was made in May, it was announced that it would take place in 6 months. So on November 1st, 2018, you would see Iran's oil supply be removed from the market, basically. And ahead of this decision, you started seeing oil production start to pick up fairly aggressively in the US, as well as in Saudi Arabia and Russia, basically trying to fill that gap in the market, because demand actually remained fairly constant, seeing continuous demand growth. Now, speaking to the real negative of having some uncertainty in terms of your leadership and policy, so November 1st, 2018, this sanction was supposed to come into place. On October 31st, 2018, the US administration decided, you know what? We're not actually going to issue these sanctions. We're going to give waivers to 8 specific countries. Now, those 8 countries included China, India, and the Eurozone, and were basically all of the export destination for Iranian oil. So suddenly you thought you would have this lack of supply of 4 million barrels of oil coming off the market. Everybody else has ramped up production to fill that gap. And then suddenly that 4 million barrels isn't going anywhere. So what happens if you have demand here, and then suddenly supply spikes higher? The adjustment is done in prices. And we saw this massive price correction. And this price correction, so this increase in supply actually was coming at a point in time where inventory, stockpiles of oil, were historically high still. So one of the measures that people like to look at in terms of oil is looking at inventories relative to where they've been over the past 5 years. And based on that measure, inventories in the US had basically normalized. They'd gone back to where their average was. But the last 5 years, inventory has been historically elevated. So looking on an absolute basis, inventories have come down from their previous peak, but they are still historically elevated. So if you have this abundance of supply to begin with, and then suddenly you're concerned that there's going to be even more oil in the marketplace, this is why you've seen sort of that sharp, massive turnaround in terms of oil prices, which ultimately did hit a bottom. Now, one of the oil prices that fell hardest and fastest as a result of these announcements and these changes was something called the Western Canadian Select Oil Prices, which is the Canadian benchmark. So Canada's oil market right now is in a very particular conundrum that they're facing. There is demand for the oil being produced. There is a lot of oil being produced. But because of the lack of capacity to actually get that oil to market, you're not able to connect those two, right? And so what we've seen is oil inventories in Alberta, where they continue to produce oil, and again, there's still demand for it, inventories have been rising and rising and rising to the point where they're at record highs. Now, there are two things that have come to pass in this intervening time. Number one is that because there's no pipeline capacity, oil companies had to find different ways to get their oil to market. And the first way they started doing it is rail lines. So if you're to go to Calgary, Edmonton right now in the oil hubs, the entire city is surrounded by train tracks with oil tankers on them. Because we've seen oil exports by rail have spiked. They have more than doubled over the past year. And the expectation is they're going to continue to move higher because, again, they need to get this oil to market. It takes a while to get these contracts into place for the rail lines, and now we're finally starting to see that play out. The other thing that happened was on December 3rd, the Alberta government pretty much came out and said that we're going to do basically a 10% cut in oil production across the province. Right? When you have an announcement like that, it's fairly significant. And the idea is that based on these production cuts, you can have these oil inventories are expected to normalize, so basically go back down to this level by the spring. So when you are able to sort of have that supply management, when demand's maintaining constant, you're going to see a fairly aggressive rebound. And I don't quite catch it. This is the price bouncing up. Anyway, so what I'm emphasizing though, like the oil prices, what's happening in the oil market is very much not driven by global macro rolling over. There's no indication that we're seeing that. This is a supply issue. And the problem being there's too much supply. No matter what demand is doing, you're soon to see these dynamics play out. And this is just looking at the Canadian dollar. What we, as Canadian investors, if we're looking at anything abroad, we've seen a weakening in the Canadian dollar. And it's actually being driven by fundamentals. This is something that isn't been out of the ordinary. Given what oil prices have done, given what interest rates have done, we've seen this. So we've got the two lines, the actual line and then a little model I have that it does a bunch of math stuff and spits out what it should look like. And it's showing that this is actually being behaved fairly well. So we're not necessarily going to see any sort of big correction in the Canadian dollar, just so something to consider when you're looking at international investments. Anyways, so emphasis on context. And the other thing that needs to be taken in, so in the event that we have equity prices continue to fall or to continue to move lower, even though they've done fairly well so far this year, when you're dealing with clients, something that needs to be hammered home to them is, yeah, markets can be volatile. Yeah, you can see things go down every now and then. But ultimately, more often than not, stocks go up. Equity markets go up. Economies grow more often than not. And this chart, it looks at, so looking at since 1988, so basically 30 years or 8,000 trading days. If you were to just buy and hold an investment in either the S&P 500, so US stock market, the global stock market as a whole, or the Canadian market, you buy and hold, your returns are pretty good, roughly 7% for global equities over the last 30 years. If you try to time the market, and it's always good to want to miss the downside moves, but unfortunately those downside moves are typically followed by really sharp up moves as well, even in like the worst case scenarios. If of these last 8,000 trading days, you happen to just miss those best 10, be outside of the market for those 10 days, your annualized returns are basically 2% lower. Now, with the beauty of compounding, that means that your investment would be 40%, just 40% of what it otherwise could have been if you stayed in markets for all of those 10 days. The more days you miss out, the worse your performance is. And again, this is looking at 8,000 trading days. Because there's research that shows basically 95% of equity market returns are generated by 3 days a year. And this is something you need to emphasize. And like when we're dealing with clients and we have some business with like high net worth, we have to emphasize it's good with pension funds because they have a long time horizon. But with individuals, you need to emphasize the fact it's time in, not timing the market that is the key to gauging wealth. You need to be smart about doing it, but maintaining that exposure is in the long run beneficial. But given that there's likely to be continued volatility in the marketplace, you can be smart about it. Right? So growth stocks, so looking at the FANGs, the tech stocks, all these really sort of sexy names, they have performed extremely well so far through this the bull market. But they don't historically perform well when there's high volatility. They actually underperform the market as a whole. So as a firm, we like to focus on these dividend and quality stocks. So high dividend, they're giving you that cash flow, they provide a buffer. And again, this is emphasizing the fact that if you expect things to be volatile, you expect there to be some downside risk, having a little bit of a cash buffer is never a bad thing. And when you're looking at going up the quality curve, so looking at higher quality companies that have more stable earnings, lower leverage, they're less of a financial risk, this is the time where you find the shelter in the storm. Now, just adding some context is, you read things saying that it seems like it's really bad. It actually isn't that bad. It's not fantastic by any means, but growth isn't rolling over. As long as we maintain growth, that means companies can grow their earnings. And if companies can grow their earnings, that means that equity markets can perform. And with that, I don't know if we want to do any questions. Well, right now, given the market environment, in terms of where we are later in the cycle than we are earlier, I guess is the best way to put it. We're in sort of a new dimension right now where historically policymakers have wanted to be really aggressive in terms of clamping off inflation. They want to make these moves, and in doing so, I think it's every recession that we've had has had the fingerprints of central banks on it, right? They raise interest rates too high too quickly, and it ends up choking off credit growth, things roll over. In the current era, given especially that we're not seeing sort of robust inflationary pressures, which everybody's concerned about because they want to maintain the value of their currencies, there's a lot of scope for central bank policymakers to err on the side of caution. So if they think there's even a possibility that they're going to have to cut interest rates in the next 6 months, they're not going to raise them in the first place, right? You're going to see a little more emphasis, like when you see central bank commentary or comments coming out, it's going to be emphasis on this patience aspect. So in terms of specifically where we are, I wouldn't necessarily say that it's the 8th or 9th inning, but we're later in the cycle than we would necessarily than earlier, I guess is the best way. So we're closer to the end than we are the beginning. But at the same point, there's a lot of research talking about which sectors to go in. So ordinarily, if you're approaching the end of the line, you should start getting more defensive. A lot of research shows this is where you have that final gasp in the cyclicals. And actually, what we've seen so far this year is because the cyclicals performed so poorly at the end of last year, they're catching the most wind. We're seeing the tech stocks rebound. And in the event that we have sort of a defined, assured agreement on the trade front with China and the US, that removes a lot of headwind, and there's a scope to pick up sort of that added sort of growth tilt. But at the same time, if you've got an investor in and you're not going to try and call the peaks or the bottoms, it's this emphasis on quality and income. So protecting, getting a little bit more defensive, not necessarily in terms of the sectors, but in terms of the company. So you ask about large cap versus small cap. Ultimately, from an investor standpoint, if you want people who are not too concerned about being able to sleep at night, taking those larger, safe, large cap, high quality companies is probably not the worst tilt to this current market environment, because ultimately volatility is going to continue to exist. We don't have trade agreements. We don't have a specific outcome of what's going to happen over in Europe with Brexit. And as long as you have that heightened uncertainty, you're going to see more volatility. And so in volatility, looking for quality and income isn't necessarily the worst solution. Again, talking about recency bias, most people in their minds, the last 2 recessions we've had have been fairly bad because they've been predicated on massive issues, like massive disallocations in the capital market. So we had the tech bubble, which anything with a .com associated with it got good money after bad thrown in it, and markets collapsed as a result, and we had a fairly bad recession. And then we had an even worse recession in 2007, 2008, 2009, when you had the financial crisis. So there was a massive disallocation in terms of credit markets. The likelihood is when we do have the next recession, and again, it is when, these are cycles, things happen. Can't exactly tell you when it's going to happen, but it was likely to happen at some point down the line. It is, for all intents and purposes right now, probably going to be a lot more shallow and sort of what's considered a textbook recession. So we'll have a couple of bad quarters, maybe even a bad year, but it's going to be fairly shallow, and then there'll be a bounce back. Oh yeah, so the longer term, especially in the context of this next recession that's relatively the viewpoint is it will be fairly calm, I guess, an orderly recession. That means you're not going to have a massive degree of government stepping in, government intervention, central bank intervention to sort of stem the losses, right? The big issue with the amount of debt that exists and with where central bank policy and all that kind of stuff is creating, they don't have a lot of ammo for the next big downturn. If they need to step up and you're already running deficits of 5% of GDP, you're already sitting on trillions of dollars worth of debt, it becomes more difficult to actually finance sort of that stopgap in funding. And then as we move forward and on, it's only going to become more and more difficult given demographic changes and and fiscal issues. So that's something that's going to create not necessarily recessionary issues, it's going to cause overall growth headwinds over the next, let's say, decade in particular, right? It's going to be more significant. But that in and of itself isn't necessarily going to cause a recession as much as it's going to create headwinds going into recession and out of it, because you're not going to get sort of that normal support. But yeah, the government debt scenario is bad. But the important thing too is, going into the 2007 financial crisis, the big issue in terms of leverage was on the household and the corporate side. And those have actually been relatively well behaved. Even if you're looking at Canada where they have the elevated debt to income ratios, if you look at where they are debt to assets, so the actual assets they hold on their balance sheets, they're in decent shape. Homeowners' equity is basically unwavering over the last 20 years. Whereas in the US, you saw that homeowners' equity as people started to withdraw, you do home equity loans to withdraw that actual equity from the house just for consumption spending. You saw that start to spike lower. You're not seeing that in Canada now. So yeah, we're going to from a corporate side, from an actual private sector side, the debt picture isn't as worrying as the government side. And the government side, because ultimately, if a government wants to, if the US decides, we've got a lot of debt, we need to find some way to pay for it, they can just print money. Ultimately, it's really bad for their currency, and that's why people don't want to do it, but it is an option, right? So yeah, this is something that's going to create headwinds. And I like to say, because I'm a market economist, because I actually am involved in investing, you always sort of keep an eye on what's happening, those longer term time horizon impacts, especially in things like demographics and fiscal policy. But in terms of making my forecasts, I aim between the next 6 to 18 months at most. Because I'm trying to think for certain, what can I see? And do I see the economy rolling over in that time frame? Not really right now. Is it possible? Absolutely, something could happen. But given on the current trajectory that we're on, don't necessarily see things rolling over. So the demographic issues facing Canada in particular, and it's basically a global issue, is that we have a lot of people who are moving towards retirement years. And typically when people are in their retirement years, they are far more of a drain on the system than they are sort of a benefit in popping it up, because they're not necessarily paying taxes anymore, right? And because you have that pig in the python demographic that is the baby boom, you're having this disproportionate amount of people reaching those retirement years. And at the same time, they had fewer kids, so the baby boom echo, the people who are now becoming the tax base and growing the tax base, is actually smaller. So one of the questions we got in Halifax was, do you see personal income taxes going up or down over the near term? I would say it is a very, very low probability that you see taxes overall go down, especially on the personal side. How they skew it is going to be interesting. This is going to be the the government policy sort of conundrum going forward, because A, they want to get reelected, and one way to make sure you don't get reelected is to raise taxes prohibitively on everybody. But at the same point, they have to have some sort of reasonable sort of fiscal plan. Because again, the demographic issue is something that has been dictated since the 70s and 80s, where people were aware, hey, we have this giant cluster of people, this cohort, where rather than everybody being sort of uniformly spread out across years, it's a big lump of people here. And they're all aging at the same time. And it has big impacts on everything from real estate markets to investment markets to healthcare system in particular. But it's how they're actually going to address this. And this is not something that's been done at any sort of sustainable level right now. So, you could see this increasing shift, and this will be important to your clients, is the idea that you could have more in terms of estate taxes. So estate management and transition and succession management is going to become sort of a bigger deal specifically for your industry. And in terms of managing the taxation, yeah, the reality is you're probably not going to see taxes move much lower than they are right now.